Dan Ives of Wedbush Securities believes the recent sell-off in AI and technology stocks has created a major buying opportunity. In a recent interview with Bloomberg, he said big tech stocks became way oversold in June and called the current AI pullback a gift for long-term investors. In this video, I'll first play you the interview, then I'll break down exactly what Dan Ives is saying and give you my own reaction and analysis. And finally, I'll reveal two AI stocks that I believe are strong candidates to buy and hold for the next decade. Let's hear what Dan Ives has to say.
Dan joins us now, and of course, when we're talking about tech, we're talking about hyperscalers in particular, which have been the huge losers until yesterday, where you actually saw a little bit of a turnaround. Why do you reject the notion that people are pushing back against the spending plans of some of these tech behemoths?
Look, the hyperscalers is $700 billion. I mean, that's what's funding the AI revolution. I mean, when you talk about memory chips, NVIDIA, and everything else, but that's just the first phase, because what the hyperscalers are doing is, this is the build out. It's Vegas Strip building in 1955. But ultimately, the monetization now is going to come. I mean, when you look at Meta, they're not just spending to spend. You look at Microsoft, they essentially own the enterprise. Alphabet, 5% of their customers have gone to the AI path. Same thing with Amazon. So my whole point is, you've had this tech rally, but Mag 7 right now, penalty box, essentially. I think it significantly outperformed second half of the year. And I think earnings season, as we see in July, I think that's going to be a huge validation moment for big tech.
So the Vegas Strip maybe is a decent analogy on the just actuality of it, not in the scale. I mean, we're talking JP Morgan expecting $5.5 trillion to spend on CapEx spend for AI heading out to 2030. We're talking about massive numbers that are accelerating, not decelerating. And capacity-constrained companies, right? I mean, some of these companies have said, we can't give you all the compute you're looking for. So how do you see them monetizing without raising prices enough to really trickle into the cost of what everybody is spending on an everyday basis?
Yeah, well, first off, for every dollar spent on, let's say, an NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. So that's extremely important in terms of what you see in terms of, you talk about some of the single stock moves, just the broadening out what we're seeing in terms of tech. And you could argue for names like Caterpillar and others. But when it comes to hyperscalers, look, it's an arms race. That's why the question is, like, can they actually cut CapEx? They can't. In other words, like, you're diving into the deep end of the pool. Because if they cut back, then they go behind others in line that will clearly go ahead of them. Anthropic, OpenAI, ultimately as they go public, they'll just have more and more cash. And I think that's the reality right now. And to those, the bears will be like, oh, it's spending to nowhere. It's the opposite. I mean, you're essentially building out a new economy for consumers, enterprises, and for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
If there is one message that Dan Ives wanted investors to hear in this interview, it is that the recent sell-off in technology stocks has created opportunity, not danger. According to Ives, the market has become too focused on short-term fears and has completely lost sight of the massive growth story that is unfolding in artificial intelligence. And honestly, after listening to his argument, I think there is a lot of truth in what he is saying. For weeks, investors have been worried about one thing more than anything else: spending. The biggest technology companies in the world are spending hundreds of billions of dollars building data centers, buying AI chips, hiring engineers, and creating the infrastructure necessary for the next generation of artificial intelligence. To many investors, these spending plans have started to look excessive. They wonder whether companies like Microsoft, Meta, Amazon, and Alphabet are throwing money into a giant experiment that may not pay off for years. That fear is exactly why so many of these stocks have struggled recently. But Dan Ives sees it completely differently. He believes Wall Street is making the same mistake that it has made during every major technological revolution. Investors become obsessed with the cost of building the future and completely underestimate the value that the future eventually creates. According to Ives, this is not reckless spending. This is the foundation of an entirely new economic era. One of the most interesting comparisons he makes is when he describes the current AI build-out as being similar to building the Las Vegas Strip back in the 1950s. Think about that for a second. Before Las Vegas became the entertainment capital of the world, somebody had to build the casinos, the hotels, the roads, and the infrastructure. At the time, many people probably looked at those massive investments and thought they were crazy. Why spend so much money before there are enough customers to justify it? But the people who built early ended up creating one of the greatest economic success stories in American history. That is essentially how Dan Ives sees artificial intelligence. Right now, the industry is still in the construction phase. Companies are building the highways and the skyscrapers of the AI economy. The revenues and profits that investors are looking for have not fully arrived yet because the infrastructure still needs to be completed. But according to Ives, monetization is now beginning, and this is where his argument becomes really interesting. He points to companies like Meta and Microsoft and says they are not simply spending for the sake of spending. Meta is embedding AI across its entire advertising business and its social media ecosystem. Better recommendations, improved engagement, and more efficient advertising all translate into more money. Microsoft has already integrated AI into nearly every corner of its software empire. From Azure to Office to Copilot, the company is creating new ways to charge businesses for productivity tools that could fundamentally change how employees work. Then there is Alphabet. Dan Ives mentions that only about 5% of Alphabet's customers have gone down the AI path so far. If that number is accurate, then the implication is massive. It suggests that we are still in the very early innings of AI adoption. Think about that. If only a tiny percentage of customers are using these products today, what happens if adoption rises to 20%, 50%, or even higher over the next several years? That could represent an enormous revenue opportunity. The same logic applies to Amazon. The company has one of the world's largest cloud businesses, and AI services could become one of its biggest growth engines for the next decade. This is why Ives believes the market is underestimating these companies. He says the so-called Magnificent Seven have been sitting in the penalty box recently. Investors have punished these stocks because of concerns about spending and valuation, but he expects these companies to significantly outperform in the second half of the year. Personally, I think that prediction is not unreasonable. Every major technological revolution has periods where investors become impatient. During the early days of the internet, there were enormous infrastructure investments before the profits eventually arrived. During the smartphone revolution, companies spent billions creating ecosystems that later became incredibly profitable. Artificial intelligence may be following the exact same script. Another major point Dan Ives brings up is the absolutely staggering amount of money that could be spent on AI infrastructure over the next several years. He references estimates that suggest as much as $5.5 trillion could be invested in AI capital expenditures by the year 2030. $5.5 trillion. That number is almost difficult to comprehend. What it tells us is that the AI revolution is not slowing down, it is accelerating. And perhaps even more importantly, demand is still outstripping supply. Many companies cannot even get enough computing power to satisfy customer demand. There are businesses that want more AI capabilities but literally cannot access enough computing resources. That is an incredible problem to have. Usually when investors become worried, it is because demand is collapsing. But here, demand remains incredibly strong. The challenge is simply building enough capacity. Dan Ives also makes an important observation about NVIDIA. He says that every dollar spent on an NVIDIA chip creates an $8 to $10 multiplier effect across the rest of the technology ecosystem. That statement deserves some attention because it highlights why AI is much bigger than just one company. When a company buys an NVIDIA chip, that purchase often leads to more spending on networking equipment, software, cloud services, cybersecurity solutions, storage systems, consulting services, and countless other areas. The ripple effects spread throughout the entire technology industry. This is one reason why many analysts believe AI could create one of the biggest economic booms in modern history. And honestly, I think this is something that many investors still underestimate. People often focus on the obvious winners like NVIDIA, but every major technology revolution creates entire ecosystems of winners. The internet created winners in software, e-commerce, advertising, payments, logistics, and cloud computing. Artificial intelligence could do exactly the same thing. Perhaps the most important point Dan Ives makes during the entire interview is his argument that the hyperscalers cannot afford to slow down. This is where he introduces the idea of an AI arms race. According to Ives, companies like Microsoft, Amazon, Alphabet, and Meta have no choice but to keep spending. Why? Because if one company decides to reduce its investments while competitors continue building, it risks falling behind. And in technology, falling behind can be incredibly expensive. History is filled with examples of dominant companies that failed to keep up with technological shifts. The winners of the AI era could become even more powerful, while the laggards may struggle for years. This competitive pressure is exactly why Dan Ives rejects the idea that companies will dramatically cut their AI spending. In his view, they simply cannot. And then he goes even further. He says that emerging competitors like OpenAI and Anthropic will continue raising enormous amounts of capital and become even stronger over time. That means the race is becoming more competitive, not less. The battle for AI leadership is only beginning. I actually agree with this point quite strongly. Artificial intelligence is increasingly looking like one of those technologies where second place may not be good enough. The companies that build the best models, the best infrastructure, and the biggest ecosystems may enjoy enormous advantages for years to come. That creates tremendous incentives to keep investing. Finally, Dan Ives pushes back against one of the biggest bearish arguments on Wall Street, the idea that all of this spending is leading nowhere. His response is simple. It is the exact opposite. He believes these investments are building an entirely new economy for both consumers and businesses. And then he makes one of his boldest statements of the interview. He says that for the first time in 30 years, the United States is ahead of China when it comes to technology. That is a significant claim, because technology leadership has become one of the defining economic and geopolitical battles of our time. If the United States truly maintains its lead in artificial intelligence, the economic benefits could be enormous. New industries could emerge, productivity could accelerate, corporate profits could expand dramatically. Of course, there are risks. AI spending could remain elevated for longer than investors expect. Some projects may fail. Valuations in certain areas of the market could become stretched. No technological revolution happens in a perfectly straight line. There will be setbacks, disappointments, and periods of volatility. But if Dan Ives is right, then the recent weakness in technology stocks may eventually be remembered not as the beginning of a collapse but as one of the better buying opportunities of this AI cycle. And that really is the central message of this interview. While many investors are focused on the enormous costs of building artificial intelligence, Dan Ives is focused on the enormous rewards that could eventually come from it. He sees an industry that is still being built, a market that has become too pessimistic, and a technological revolution that is only in its early chapters. Whether you agree with him or not, one thing is becoming increasingly clear. Artificial intelligence is no longer a future story, it is happening right now, and the companies willing to spend billions today are betting that they will own the economy of tomorrow. Now let's dive in and break down the two artificial intelligence stocks that could quietly become some of the biggest winners of the next decade. Let's start with the first stock, Iren, ticker symbol IREN. A lot of investors still think of Iren as a cryptocurrency mining company, but that description is becoming more outdated by the day. What this company is actually doing right now is transforming itself into an AI infrastructure company, and that shift could completely change its long-term future. The reason this matters is simple. Artificial intelligence models need enormous amounts of computing power. Every time a company trains a large language model or runs AI inference at scale, it requires massive amounts of energy, data center capacity, and advanced computing infrastructure. There is not enough of this infrastructure available. In fact, one of the biggest bottlenecks in artificial intelligence today is compute capacity. The demand for AI data centers is exploding, and the supply is struggling to keep up. That creates a huge opportunity for companies that can build these facilities quickly and efficiently. Iren has recognized this opportunity and has been moving aggressively. Over the past several months, the company has been loading up on gigawatts at an astonishing pace. Year to date, it has more than doubled its total number of gigawatts from 2.9 to 5.8. That is an enormous expansion. When you see a company doubling its power capacity in such a short period of time, you should pay attention because power is becoming one of the most valuable assets in the AI economy. Without electricity, there is no artificial intelligence. Every AI data center requires enormous amounts of power. The more power a company controls, the more computing infrastructure it can build, and the more customers it can attract. This is why Iren's strategy is so interesting. The company is positioning itself to become a major provider of AI compute infrastructure at a time when demand is accelerating faster than supply, and the market is beginning to notice. One of the biggest developments for Iren recently was its 5-year agreement with NVIDIA. The deal is worth approximately $3.4 billion for 60 megawatts of capacity. That works out to an average annual value of around $11.3 million per megawatt. Think about what that tells us. One of the most influential companies in artificial intelligence has decided to partner with Iren. That is not something that happens by accident. Large technology companies are extremely selective about where they deploy their capital and computing resources. They want partners that can provide scale, reliability, and long-term capacity. This agreement is an important validation of Iren's strategy. It suggests that the company is building infrastructure that major AI players actually need, and this could be just the beginning. The artificial intelligence market is still in its early stages. Every month we hear about new data centers, new AI projects, and new models that require even more computing power. The amount of infrastructure needed over the next decade could be almost unimaginable. I think many investors still underestimate just how big this opportunity could become. Artificial intelligence is increasingly looking like electricity or the internet. It is becoming a foundational technology that could touch nearly every industry. And if that happens, then demand for computing infrastructure could continue growing for years. This is exactly where Iren wants to be. Another thing I find fascinating about this company is the speed at which it has built its AI data center pipeline. According to recent reports, Iren has developed its pipeline faster than several competitors in the space. That speed matters. In technology, being early can create enormous advantages. Companies that secure power capacity and build infrastructure before everyone else may end up controlling some of the most valuable assets in the industry. However, there is also an important challenge investors need to understand. Despite its impressive infrastructure growth, Iren has not secured as many hyperscaler deals as some of its competitors. That means the company still has something to prove. It has built the stadium, but it now needs to fill the seats. This is where execution becomes critical. The company is borrowing billions of dollars to purchase NVIDIA chips and build additional AI infrastructure. That is a significant financial commitment. Management clearly believes the returns on these investments will justify the risk. And honestly, this is where investing becomes interesting. Sometimes the biggest opportunities come from companies making bold bets before the market fully appreciates what they are building. But bold bets can also create risks. If demand slows, or if the company struggles to attract customers, the financial burden could become problematic. This is why Iren is not a low-risk investment. It is a company making a very aggressive move into one of the fastest-growing industries in the world. The reward could be enormous. But investors should also understand that there are execution risks involved. What makes the story more compelling is that the company expects those investments to begin paying off soon. Management recently increased its projected annualized run rate revenue from $3.7 billion to $4.4 billion. That is a massive increase. Whenever you see management raising revenue expectations by hundreds of millions of dollars, it usually means they are seeing stronger demand and greater opportunities than they anticipated before. The market loves growth, and if Iren can deliver on those expectations, investors may begin valuing the company very differently. Another thing that makes this stock intriguing is its performance relative to other AI infrastructure companies. Some competitors have enjoyed enormous rallies this year. Iren has not experienced the same type of explosive move. In some ways, that could actually be an opportunity. Because if the company begins securing more major customers and demonstrates that its investments are generating meaningful returns, there may still be substantial upside left in the stock. I often remind investors that some of the best opportunities come before the crowd fully understands the story. When everybody already agrees that a company is a winner, a lot of the upside may already be reflected in the share price. But when a company is still proving itself and building its future, that's where asymmetrical opportunities can exist. The market is essentially asking one question right now: can Iren turn all of this infrastructure investment into sustainable and profitable growth? If the answer is yes, the company could become one of the more interesting long-term AI infrastructure stories on the market. The reason I believe this stock deserves attention is because artificial intelligence is creating a completely new asset class. Power capacity and AI compute are becoming strategic resources. The companies that control those resources may end up holding incredibly valuable positions in the future technology ecosystem. Think about it this way. During the internet boom, investors focused on websites and software companies. But many of the biggest winners were the businesses that built the infrastructure that made the internet possible. Artificial intelligence could follow a similar path. The infrastructure providers may become some of the biggest beneficiaries of the entire revolution. Iren is positioning itself exactly in that lane. Now, I am not saying this stock is guaranteed to become a huge winner. There are risks. The company needs to execute. It needs to attract additional customers. It needs to manage its debt responsibly. And it needs to continue building infrastructure efficiently. But if management succeeds, the opportunity could be much larger than many investors currently realize. This is the kind of company that could look completely different 5 or 10 years from now. Today, many people still see it through the lens of its past business. In the future, investors may view it as a major AI infrastructure company. And sometimes those types of transformations create some of the biggest investment returns. The AI revolution needs power, it needs data centers, it needs compute, and Iren is trying to become one of the companies providing all three. That alone makes it one of the more fascinating AI stocks to watch over the next decade. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock, and this one is already a giant in the semiconductor industry. Broadcom, ticker symbol AVGO. When most investors think about artificial intelligence chips, they immediately think about one company. But there is another player quietly becoming one of the biggest beneficiaries of the AI boom, and its opportunity may be much larger than many people realize. Broadcom specializes in something incredibly important: customized AI chips. That may not sound exciting at first, but it could become one of the most valuable niches in the entire semiconductor industry. Here's why. Not every technology company wants to rely entirely on general-purpose AI chips. The largest technology companies in the world increasingly want chips that are designed specifically for their own workloads, their own data centers, and their own artificial intelligence applications. Think about it like this. A general-purpose chip is similar to buying a luxury SUV. It can do a lot of things very well. A custom AI chip is like owning a Formula One race car that has been built specifically for one track and one driver. It is designed to maximize performance and efficiency for a very specific task. And in artificial intelligence, efficiency matters. The amount of electricity required to train and run AI models is becoming enormous. Companies are spending billions of dollars on computing infrastructure and energy costs. Even small improvements in performance and power efficiency can save these companies huge amounts of money. That is where Broadcom comes in. The company has become one of the leading designers of custom AI accelerators that allow major technology companies to optimize their infrastructure and improve performance. The demand for these chips has exploded. The numbers tell the story. During its fiscal 2026 second quarter, Broadcom delivered an impressive 48% year-over-year revenue growth. That is extraordinary for a company of this size. When mature technology companies are growing revenue at nearly 50%, investors should pay attention. But what is even more impressive is where that growth is coming from. Broadcom's AI-related revenue surged by 143% year-over-year, 143%. That kind of growth does not happen by accident. It tells us that the demand for AI infrastructure remains incredibly strong and that Broadcom is capturing a meaningful piece of that opportunity. Even more remarkable, AI-related products now account for almost half of Broadcom's entire sales. Think about that for a moment. A business that was once known primarily for networking and semiconductor products is rapidly transforming into one of the biggest artificial intelligence companies in the world, and that transformation could still be in its early stages. If AI-related sales continue growing at this pace, artificial intelligence could become the dominant driver of Broadcom's revenue and profits over the next decade. This is one of the reasons I believe so many long-term investors are paying attention to this company. Broadcom is not simply participating in the AI boom, it is becoming one of its key architects. Another thing that excites investors is profitability. Growth is wonderful, but growth without profits can be dangerous. Broadcom has something even better: massive growth combined with massive profitability. The company recently reported that net income nearly doubled from the previous year and delivered an incredible 42% net profit margin. 42%. Very few companies in the world can achieve that kind of profitability, and high margins matter because they give a company flexibility. They allow management to invest in research and development, pursue acquisitions, reward shareholders, and continue innovating without placing the business under financial strain. High margins also create resilience. Technology cycles come and go. Competition increases, markets become volatile, but highly profitable companies often have the resources needed to adapt and keep growing. That is one reason why Broadcom has become a favorite among many long-term investors. The company has already proven that it can execute at a very high level, and now artificial intelligence is creating another major growth engine. Perhaps the most fascinating development came recently when Broadcom unveiled a custom AI chip designed specifically for OpenAI. The chip is called Jalapeno, and this may be one of the most important developments investors are overlooking. According to early testing, this new chip delivers performance per watt that is substantially better than the current state-of-the-art. That phrase may sound technical, but it has enormous implications. Performance per watt essentially measures how much computing power you get for the amount of energy consumed. In the world of artificial intelligence, that is becoming one of the most important metrics. AI models require tremendous amounts of electricity. As models become larger and more sophisticated, the need for efficient computing becomes even greater. A company that can provide better performance while using less energy may gain a significant competitive advantage. This is why custom chips are becoming so important. The largest technology companies are no longer satisfied with generic solutions. They want chips that are tailored to their specific needs and workloads. Broadcom is positioning itself right at the center of that trend. And if it continues delivering strong performance and efficiency, demand for its products could continue growing for many years. I think this is one of the most underappreciated aspects of the AI investment story. Everybody focuses on chatbots and consumer applications, but the real economic engine behind artificial intelligence is infrastructure. The chips, the networking equipment, the data centers, and the computing systems are the foundation upon which everything else is built. Without that infrastructure, none of the flashy AI applications can exist. Broadcom is helping build that foundation, and that is exactly why I believe this company deserves serious consideration from long-term investors. Another thing I love about Broadcom is that it has multiple ways to win. Even if one customer slows spending, the broader demand for AI infrastructure remains enormous. Artificial intelligence is becoming a strategic priority for companies around the world. Businesses want to automate processes, improve productivity, and develop new products and services using AI. All of those initiatives require computing infrastructure, and all of that infrastructure requires advanced chips. The market opportunity here is enormous. Some analysts believe that artificial intelligence could eventually become a multi-trillion-dollar industry. If that happens, the demand for customized AI chips could continue rising for many years. Broadcom does not need to dominate the entire market to create significant value for shareholders. It simply needs to continue executing and maintaining its position as one of the leading suppliers of custom AI solutions. I also think there is another important point investors should consider. The semiconductor industry often rewards companies that build deep relationships with their customers. Once a company designs a custom chip and integrates it into a customer's infrastructure, switching to another provider can become difficult and expensive. That can create sticky customer relationships and recurring demand. In investing, those kinds of competitive advantages can be incredibly valuable. They can create long periods of sustained growth and profitability. And Broadcom appears to be building exactly that kind of business. Could the stock experience volatility? Absolutely. Technology stocks always experience periods of uncertainty. Competition could increase. Economic conditions could weaken. AI spending could fluctuate. But when I look at Broadcom, I see a company that has already proven its ability to adapt and execute across multiple technology cycles. Now it is benefiting from one of the biggest technological transformations of our lifetime. That combination is powerful. The market has already rewarded Broadcom shareholders over the years, but I would not be surprised if this company still has significant upside ahead. If artificial intelligence continues growing at anything close to current expectations, Broadcom could remain one of the most important companies in the AI ecosystem for the next decade and beyond. And that is why it earns a place on this list of AI stocks to buy and hold for the next decade. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. As investors, it is easy to get distracted by daily headlines and short-term market swings, but wealth is often built by identifying major trends early and owning great businesses for long periods of time. The artificial intelligence revolution could be one of those trends. Iren is making a massive bet on becoming a critical provider of AI infrastructure and computing capacity. Broadcom is becoming one of the world's most important suppliers of customized AI chips and advanced semiconductor solutions. Both companies are approaching the AI opportunity from very different angles, but both could benefit enormously if artificial intelligence continues reshaping the global economy. Now I want to hear from you. Which company has the bigger long-term advantage? Do you believe Iren's AI infrastructure strategy has more upside, or do you think Broadcom's custom chip business makes it the stronger investment over the next decade? Let me know in the comments below. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.